Thanks again, everyone, for being with us today. We're going to jump into, and be covering several key performance indicators or KPIs, as well as some additional drivers that impact, the wealth advisor industry specifically. So if we look right to the definition of a key performance indicator, it's really a measurable value that demonstrates how effectively a company is achieving its business objectives, right? So organizations generally use KPIs to evaluate their progress and success at reaching certain targets. And what makes them most beneficial is that they're objective, measurable, and allow for comparability, which is a really important piece of them. And if we think about the phrase KPI, it's a relatively, ambiguous term. Metrics can range from financial to operational, from quantitative to qualitative. And, within the valuation realm, there's a specific focus on financial KPIs, mostly because valuators look at ratio analysis. And it's helpful too for business owners because they can just grab their financial statements, which are typically, pretty readily available. And, very quickly they can ascertain some relevant metrics on their performance. And I think we'd agree, owners who take the time to, look at their revenue and expenses on, at least a periodic basis, and they're looking for anomalies and changes in expenses, maybe, they're in a good position to understand their financial position. But, while this analysis is, still pretty good, it doesn't highlight the trends and red flags, that KPIs can actually bring to light. So again, KPIs play a pretty critical role in a company in that they offer quantifiable and measurable statistics regarding the company's historical performance. And for advisors and business owning clients, understanding these KPIs and what they mean to a business financial health and how they ultimately can impact value is pretty important. So moving on here. So there's obviously, tons of KPIs that we could cover. We're going to cover 7 core financial KPIs for this presentation purpose, and it pretty much provides digestible data for the business's financial health, and it allows users to identify trends more easily. So it's hard to say there's any one sole KPI that would be most critical, even looking at it from a valuation standpoint. But if we, take a look at, multiple KPIs and measures, collectively, they have the opportunity to impact the value of the company. There's a saying that says, what gets measured gets managed. So, what you're focusing on as a business owner, or if you can assist, clients in focusing on certain metrics, you can really manage the end result. So if you're looking to get a higher valuation, understanding the underlying, ratios and metrics of your business is going to be pretty paramount to that. So, as we go through, the next couple KPIs here, we'll go through some of the formulas for each, how to interpret them, how to interpret the results, and how they kind of play an integral part in value. Just one, important thing as we kind of look at some of these metrics is, when we get a result from a ratio, it's rather meaningless in a vacuum. And what I mean by that is if, we run a ratio and we get a number, standalone, it doesn't provide much value. When we run what we call a trend analysis, so we look at the same ratio over a period of years, well, now we can take a look at our own internal ratio and kind of distinguish how we're trending. Is it going up? Is it going down? Is that good? Is it bad? And also when we get that result, we can compare it to industry peers to see, how we're kind of comparing to the norms. So okay, jump here. So, first we're going to take a look at the cash to debt ratio, which allows a company to assess its ability to service its debt with available cash. Typically, a higher ratio can signal that the company has a lower probability of defaulting on its liabilities, and a lower ratio, signals the opposite, that it has a higher chance of defaulting. So from a formulaic perspective, we're going to look at for the short-term and long-term liabilities and divide that by operating cash. And, all of these components are going to be found on the balance sheet. Just as an aside from a formula perspective, whenever you see a ratio as something to something, as in cash to debt, the first word there is, like in this case, cash, it's going to fall in the numerator with the following being going in the denominator. So if we look at the cash to debt, let's say we take an example, for instance, let's say we have, a furniture store with a ratio of 74%, right? We have a client who's in a furniture business, we run the ratio, we get 74%. So that means for every dollar of debt the company has, they have $74 in cash that can be used to service this debt. So when we initially see something like that, we might be worried, right? It's just a standalone ratio, that's all we have, but we really want to kind of watch this trend over time, specific to the company we're looking at. If that ratio had been falling, maybe we've taken on more debt or cash has been reduced. On the other hand, If the ratio has been increasing or has remained, steady, it indicates that we have, either a slightly growing or maybe a mature company. It's also helpful to, again, like to reiterate this, that, we want to compare it to industry peers, right? If, in this industry, a normal cash to debt ratio is 50% and we have a 74% ratio, we're actually, superior to our industry peers there. So again, it kind of just reinforces the fact that we want to look not just at our own, but at how we stand, compared to industry norms. Go ahead and jump to the next slide here. 1 second. All right, so we have debt to equity ratio, widely utilized solvency ratio here, and it compares the company's total debt to equity. To arrive at the appropriate formula, we're going to go to the client's balance sheet, and we're going to divide the company's liabilities by its shareholders' equity. So a high debt to equity ratio comes with a little risk, right? If the ratio is high, it means the company's borrowing capital from others to finance its growth. And lenders and investors often lean toward companies that have lower debt to equity ratios. So, why that's the case, sometimes you're going to have, capital intensive industries that are always going to tend to have higher ratios. And in contrast, you're going to have things like service industries where, capital and growth needs, aren't really, as dependent there. So again, it's kind of important to compare this ratio trend. If we had a debt to equity ratio and we see a sudden increase in our own ratio, it could mean that the company is, funding its growth strategy pretty aggressively with debt. And, just to use an example here, let's assume, we have a company with a debt to equity ratio of 0.5. Again, this means that for every dollar of equity, the company has 50 cents of debt. This can vary industry by industry, so it's kind of hard to say what a normal one should be. But, comparing it to yourself and your competitors is going to give you, a good, feel for where you're positioned. And then, really from a valuation standpoint, we can kind of use this, again, not every ratio is going to automatically mean a lower or higher value. But, if we have a high debt to equity ratio, it means we probably have a little bit more risk here. And risk is a pretty key factor when we're looking at valuation. All right, jump into the next one here. We have interest coverage ratio. So this is another common metric. It's known as the interest coverage ratio. You might sometimes see it referred to as the time interest earned ratio. And, besides the mandatory debt principal obligation that comes due when a company borrows debt, the companies also have to service the interest payments on the debt to avoid defaulting. So this interest coverage ratio can be pretty helpful in understanding whether the company has the cash flows, if they're sufficient enough to pay off the required interest on the debt. So to develop this formula, we're actually going to take a look at the profit and loss statement here first and look for what is called earnings before interest and tax. It's going to be commonly referred to as EBIT. And then sometimes you might see it written as operating profit on financial statements. And then we're going to divide this number by the interest expense. So the lower the interest coverage ratio, the greater the company's debt and possibility of bankruptcy. And then a lower ratio indicates that less profits are available to meet interest payments. And then conversely of that, a higher result from this ratio indicates the company is better, positioned to meet the interest payments coming due. So, look into an example here. If we have a company that had, 500,000 in EBIT and 50K in interest, that's a coverage ratio of about 10 times. That means the earnings before interest and tax of the company can service the interest 10 times. Now, let's say that ratio were to drop to, 1 times. That could signal that even a slight drop in the, operating profit of the company could, cause a default from missed interest payments. So this ratio is going to be more commonly used by lenders, creditors, and investors to determine the riskiness of lending capital to a company. All right, days sales outstanding. I would think this one's actually pretty important to, all companies across all industries. So we have the, days sales outstanding, DSO, sometimes referred to as receivable conversion. It's the average number of days that it takes a business to collect its receivables after a sale. So from a formula, we looked at both the company's income statement and balance sheet. We're going to get the average AR from the balance sheet, and then we're going to get the, the total credit sales from the income statement. And it's a critical business metric because it really signifies how good a business is at recovering its, past dues. In, simple words, a high day sales outstanding, could indicate that a business takes more time to collect what it's owed. And this could be because of a few different reasons. Maybe the business lacks customers who pay on time, or it could also refer, or point to the fact that the collections procedures are just not that efficient. A business with a high day sales outstanding often fails to convert cash, and in some cases, it has to write off that debt. And as a result, this can be kind of lead to a little bit of an unstable financial health. Conversely, a low DSO suggests you can collect your AR pretty quickly, or that you have prompt paying customers. Either way, it's a pretty good sign. It's a good thing for owners to focus on if they can speed up that cycle and really increase sales in the current period. All right. So moving on, we have the inventory turnover ratio, which addresses how efficiently goods are being sold by calculating how many times a company's inventory is replaced or sold in a given period. So to calculate this ratio, we're going to take net sales from the income statement divided by average inventory, again, from the balance sheet. We really consider the average here because if we use the ending inventory, just not as accurate. Using the average can kind of filter out any seasonality, so we get to a little bit more accurate ratio. As with many KPIs, there's actually variations to this formula. If you went to Google, you might see it as cost of goods sold instead of net sales in the numerator there. Cost of goods sold typically used a little bit more for internal inventory management, whereas sales can be used if the cost of goods sold isn't readily available in the financials, and you probably get a little better comparability with other companies there. So a relatively low inventory ratio can signal, be a sign of weak sales or excess inventory. And then a higher ratio could be stronger sales, but it could also mean that, you have inadequate inventory stocking for your company. So if we look to an example, if we have a manufacturer that has a ratio of 5.7, it means that they sold their average inventory about 5.7 times over the year. All right, so very popular metric here, the return on equity, I think most might be familiar with. This measures the firm's ability to turn equity investments into profits. To put it another way, it measures the company's profitability by depicting how much profit a company generates from the money its shareholders invest. The percentage is key because it helps investors understand how efficiently a firm uses its capital to generate profit. So the ratio is calculated by taking the net income of the company divided by the total shareholder equity, with a higher ROE signaling that a company efficiently uses its shareholders' equity to generate income. And then a lower return on equity means that the company earns relatively little compared to its shareholders' equity. So if we have an e-commerce company that has an ROE of 0.48, this means that it generated 48 cents in net income for every dollar the shareholders have invested. From a valuation standpoint, this can obviously be meaningful to a potential buyer because they would want to understand the potential return on their investment. All right, so for the final financial KPI, we have cash flow to revenue. This is calculated by taking operating cash flow and dividing by net sales. So there's various measures of cash flow that can be considered here, such as seller's discretionary earnings. Again, when comparing against industry peers, we just want to make sure we're comparing against the same benchmarks there. But really, this ratio is a multi-purpose ratio that's an indicator of a firm's ability to convert sales revenue into spendable cash for owners. So a higher percentage is going to indicate that the company is able to turn higher amounts of revenue into cash flow. As a bit of an example, if we had a winery that has a percentage of about 11%, it means for every dollar in revenue, it's generating around 11 cents in discretionary cash flow. And the higher we can get cash flows, the higher we can get valuation. So a good metric to keep an eye on there. So someone might wonder how do all these different financial KPIs really tie into valuation. So valuation, at the risk of kind of oversimplifying it, is heavily influenced by a couple of things, mainly cash flow, risk, and growth. So each of these metrics kind of helps us, take a look at this and identify trends in businesses. We can spot strengths and weaknesses. Maybe we take a look and we see debt's been increasing, which places operations at risk. Maybe we look at these metrics, and we see that we have a high return on investment, which is, what a buyer actually wants to see. Perhaps we see the days sales outstanding is a little bit slower than what we want. Maybe we can speed that up and get increased sales and perhaps increase the value. So just keeping an eye on these metrics and how they change over time is really going to be pretty valuable to any business owner trying to look at the value of their company. Okay, and then so some drivers for the the wealth manager kind of industry specific. So, we have these financial metrics which can really span across all industries and, pretty much all companies. But, when we look at each industry, there can always be metrics that we pull out that are specific to that industry. And some industries, more than others, are kind of relying on a little bit of, an extra kind of peek behind the curtains to see what's going on in the company. So, for example, in the financial advisor wealth management industry, the first thing we probably want to take a look at is total assets under management, and we can really go a couple different ways here. How much assets under management does the company have? How does that compare to its industry peers? Typically, you'll see firms generally targeting around 100 million assets under management, but it can really depend on a bunch of different factors. Next, we have the total number of clients. Again, a good metric to kind of take a look at for a company, and something a buyer would definitely be interested in when they're looking at the company. Is it a smaller company? Is it a larger one? Buyers will typically pay more for larger companies, but that's not always the case here. Maybe we have fewer number of clients, but they have higher net worth, right? So no real pinpoint number there, but generally, more clients is going to be more beneficial to the value. Really big factor, average age of the clients. So, in this type of industry, the younger the client is, the more value they really have, right? Because they have a longer runway here. So very important. And then how much fee is recurring, right? So, it's very helpful from valuation terms. I keep saying hypothetical buyer because it's the easiest way to think. If you were going to purchase a company, what would you be interested in, right? So how much of the fee is recurring, right? I care about, that the revenue stream is reliable. So that's a very important factor there. So obviously the higher you get, of your total 100% being, the top end of your revenue, the closer you can get to that number being recurring, the more value you're going to bring to your company. And then, looking at the 5-year asset under management growth kind of ties back into the first point. But again, growth is very big in valuation. A buyer will spend more for a growing company, knowing that the cash flows are going to only increase over time.